Hello, with me today is Sean Ringsted, Chief Risk Officer and Chief Digital Officer of Chubb, one of the world's largest P&C insurers. Chubb is also a leader in the cyber insurance space, with AM Best recently estimating their 2019 US cyber insurance premium at over $350 million and growing, making it the largest US cyber insurance carrier based on AM Best's reporting. Sean, thanks for being with us.
Thank you. Good to see you, Pascal.
You too. What have been the drivers of Chubb securing this pretty impressive leadership position in the cyber insurance space?
Well, we've been insuring cyber risk for about 20 years now, and clearly the risk has involved significantly in that time. And I think we've become market leaders because we've really dedicated ourselves to the risk and being nimble and evolving along with the industry. Clearly, the risk has evolved significantly over that time, but we've been very dedicated and focused to furthering our understanding around the risk and serving our clients. I think if you take a look back, there are probably a couple of milestones along the way that when I look back, I think are very, very influential in that journey. So I think the first one would be in 2003 when California passed the first data breach notification law, and many other states followed after that. And enterprises were not only of insurance, but a full range of services after that. And so, we and others sort of stepped up and collaborated. And you need insurers, you need law firms, you need forensic providers, et cetera, to really stitch something together in a structure and a product offering to clients. And I think that structure's remained largely intact, although I think insurers have really sort of acted as a central point of coordination and funding, right, between the various incident service providers. So you go back to 2003, and I think that's when it really all kicked off. And then for us, I look back at 2015 when ACE and Chubb came together. I think both firms were very strong on cyber, but we really asked ourselves, what should the new company's approach to cyber should be? And when we looked at the marketplace, we found, I think it's fair to say, a marketplace that was fairly fragmented. And I think it was frankly confusing, right? Whether it's sort of agents or brokers or customers. And rather than offering, say, a cyber product for a large firm or a small firm, or if you're specializing in healthcare and other industries, we really wanted to put all that together and bring out a flagship offering. And clearly, cyber's become so much more than just than coverage. It's also about pre-incident services. It's about post-incident services that go along with it. And so we put all that together and to come up with a cyber ERM product, enterprise risk management, and really sort of cyber, a cyber insurance program in a box that we could give to our clients. So that's the journey that we've been on, and as we look ahead in terms of the product and the industry, first and foremost for us is digitize the business, right? And whether it's distribution or underwriting, claims, all of that, there are real opportunities there to digitize that to improve the customer experience and so on. I think more broadly, it's really sharing our insights. Cyber is I think it goes without saying, but it really is a societal risk today. And I think we in the industry, we have some unique insights, right, that are very relevant to addressing those risks. So we're very much looking from where we sit to collaborate very closely with technology community, the cybersecurity community, the government. In fact, we've made much of our cyber data available to the public. You can go to www.chubbcyberindex.com and have a look. So I think, just really with key stakeholders, raising awareness around cyber risk is, I think, a very, very important role for us, and we're looking to carry that on in terms of a leadership position. And then generally, it's, on top of that, it's evolving the product and the service, and making that available. It's not just the large companies that have this risk; it's the small companies to the individuals, and we're very excited about the opportunities that are in front of us.
Well, it's certainly been an impressive journey and an impressive post the ACE acquisition merger that Chubb continued the momentum that it had. I would imagine it's also been a relatively profitable journey as well, considering that attritional loss ratios have historically been quite attractive in the cyber insurance space. But as Chubb's Chief Risk Officer, how much of a concern is the potential for catastrophic cyber aggregation events and the impacts that could have on Chubb's balance sheet?
Right. Well, I think, well, first of all, I'm not sure if the characterization of attractive historical loss ratios can be applied without just a few qualifiers, right? I mean, clearly there have been pockets of strong performance, but also real pockets of loss pressure, I think. Clearly ransomware is very much an issue in the industry, but I mean, that's not the only driver of attritional loss. You think about business email compromise, or even just what I call good old-fashioned data breaches, right? And cyber incident frequency is some of the highest levels we've seen, and I don't think any industry or size segments immune from that. But your broader point is spot on. In addition to these attritional frequency losses that are there are a variety of catastrophe scenarios that are out there that can have a major impact on the cyber landscape and on the industry balance sheet, and on the Chubb balance sheet. And we've had examples of, I think, of near misses, right? I mean, if you were to look at NotPetya, which exploited a tax software tool called MEDoc, and that spread indiscriminately, and it was very, a fairly low key tool. Now you imagine if a more widely used tool had been penetrated and compromised, say in the US. So, and if the attack vector had been very different, you'd be looking at a very, very different outcome there. Notwithstanding that, it's one of the, I think, most costly cyber attacks that we've experienced today. And there are other examples like that. So I mean, if you look at WannaCry as an example that exploited a vulnerability. Now, if that exploited a 0-day vulnerability, again, you're looking at a different story. So you can run through these near misses, and now you start to imagine much worse scenarios. And those need to be managed thoughtfully in terms of how you think about aggregate, how you think about segmentation of the portfolio, how you think about use of reinsurance, and importantly, putting limits around that to protect the balance sheet. So we're always stress testing the portfolio to ask those questions, right? If X happens or Y happens, what happens to you? And that's not just financially. We also look at it in terms of our policyholders expect really good claim service. And so we want to make sure that in those tail events, right, that applies to all of our policyholders. If they get hit in the same attack in the same period, right, that we have plans in place and ready to go with that.
I would imagine that this is in the same way that this is a dynamic landscape on day-to-day attritional losses. And as you rightly point out, ransomware has been a very big deal in recent years and quarters. I would imagine a lot has changed on your views and thinking on cyber aggregation in recent years. So I'd love you to just to comment a little bit more on Chubb's journey over the last 5 years or so, particularly if you turn back the clock before WannaCry, before NotPetya. I would imagine this could have felt a little bit theoretical, these aggregation events. We've now seen some of these near misses, and I'm curious how that has impacted Chubbs' journey on modeling and understanding cyber aggregation over the last 5 years or so.
Yeah, you're right. And I think, the way I describe our modeling approach is just a healthy paranoia. And you keep pushing, and it's relentless in terms of trying to dimension threat vectors, how you might think about the calibration of those, and then what happens to our clients, right? If events happen. So it's a constant grind in terms of accessing outside firms, right, that add a valuable insight, right? For like CyberCube, for example. And when you have your scenarios, just keep going deeper and deeper into those, particularly ones that have the severity potential. And it's looking for different opinions, different modeling methods. We'll make use of deterministic, we'll make use of stochastic, for example, and clearly you're after data to dimension the exposure and to dimension the outcomes. But it's relentless, and I think all of it is underpinned by healthy paranoia. And no, it's not much different, I think, to other perils, frankly, when I look back, right? Our degree of understanding and sophistication is that much greater. But you go forward knowing that it's just not enough. You have to keep pushing.
So I'd love to build on that comparison to other perils. Clearly, NatCat models have been around for decades. And so from your perspective, are there any lessons learned for those undertaking cyber catastrophe modeling, aggregation management, in terms of what the insurance industry should replicate from what was done and done well in the NatCat space versus what should be avoided in terms of the evolution of the space as we move into the world of cyber?
Well, it's really interesting, isn't it? And I've been around the NatCat space for longer than I care to admit, right? And so I think it's a natural reference point, right? But cyber clearly presents some very clear differences to NatCat risk. I think for a number of the cat perils, right, you do have historical data that stretches back, right? That you can imagine events, and you can imagine the physical representation of those events. You don't have that with cyber. I think most, fortunately, NatCat events too, right, are bounded by geography. And by time, and potentially cyber is different that way. And I think too of the underlying exposure, the exposure profile, right, as economies digitize quicker, and now you have the automation, the interdependency, the connectivity that we see, so that the underlying exposure profile, I think is becoming very, very complex, very, very, very quickly. And so I think you put all that together, and it leads you to a tail risk that may not be as well understood for CAT. And it's interesting, right? The common reference point for cyber modeling is NatCat. But I think coming out of the pandemic, that may be a more natural reference point in terms of both the frequency. You think of lower frequency, higher severity out in the tail. I mentioned the geography and time aspect to it. And pandemics have that property too, where they're not bounded by geography and time. And then you think about the complexity post-event. Yes, there's complexity with a NatCat, and the wind blows through, and you may have coverage disputes around wind and storm surge. But as we've seen through pandemic, the complexity of coverage wording and interpretation and the broad economic, social, business outcome, that could be very different from what was initially contemplated. So I think pandemics could be an interesting parallel rather than that cat to cyber risk.
Right, and if I might add one other point, which I would to pile onto that, is just the importance of business interruption and contingent business interruption that resulted from the pandemic. And I know at CyberCube, when we do our NetCat modeling, it's something that our kind of CyberCat modeling, it's that business interruption that's a big loss driver, and certainly there are lessons to be learned on the scale of the challenge as we look at the cyber space.
I think that's right, and when you look at the data available to dimension that, right? I mean, clearly you can access data that gives you an outside-in look, if you will, right, in terms of vulnerability or service provider connectivity, but to actually have a detailed understanding of the insured actual business dependencies, to your point, and what that means to them post-event and their connections into other parts of the economy and so on. I think that makes it that much more challenging to dimension business interruption, to your point.
So looking forward, what value would be unlocked to the insurance industry in a world where cyber catastrophe modeling starts to reach maturity?
Well, I think tremendous value. I'm not sure we're ever going to reach maturity, right? Much like the comments around that cat, right? But I mean, clearly, I think our understanding is going to accelerate and continue to accelerate, right? And we're going to be able to dimension and fathom how to think about exposures and develop coverages that way. So, I mean, that clearly, I think, is the path we're on. At the same time, I mentioned, the digitization of economies and just that growing demand and interdependency on cyber. So, while our understanding may accelerate, I think it's very real that the need will outstrip that, right? And we're going to be looking at exposures that are truly significant out in the tail. And much like pandemic, or say some of the larger NatCats, where there's simply this concentration of risk, I think that leads you to a place, yes, the insurance industry can and will do more because our clients demand that. But at some point, right, I think you're entering a time and space where there needs to be discussions around public-private partnerships to be able to address some of the really significant tail risk that could potentially arise in some of the scenarios.
Well, certainly an enormous challenge to society, but also an enormous opportunity to the P&C insurance industry and to carriers such as Chubb. Sean, thank you so much for your time.
Thank you, Pascal.